charitable giving and taxes with the FI tax guy, Sean Mullaney. This week on the Extreme Personal Finance Show. My guest is Sean Mullaney. He's an advice-only, fee-only fiduciary planner and a super rad dude. Alongside Cody Garrett, he's the co-author of the brand new book, Tax Planning to and Through Early Retirement. A lot of people know Sean as the FI tax guy, where he blogs at the Plutus award-winning blog, FITaxGuy.com. That's where I first discovered Sean. He shares his clear, actionable strategies on ChooseFI, Stacking Benjamin's Show, How to Money, and BiggerPockets Money. He's also been quoted in the Wall Street Journal, the New York Times, and MarketWatch. Today, we're going to break down charitable giving, such as donor-advised funds, QCDs. Do you guys know what QCDs are? What's changing in 2025 and 2026, and how to really line your purpose with planning to support the causes and the organizations that you really care about. So let's hang on tight and strap in with Sean Mullaney. Sean, how's it going, man?
Going real good, Chris. I'm glad to be here today. And I think it's sort of an intersection of our interests, right? Taxes and charitable giving. You know, if you did the Venn diagram, including the baldness, that'd be in there. And the taxes and charitable giving, that would be in there as well, Chris.
That's awesome. That's awesome. Well, I know you and I, we got to hang out in person. So we got to catch up at FinCon earlier. That was in Portland this year. And here we are. And I know you and I talked about, again, that how we're kind of both aligned in that way, like in our interests and stuff. And I want to basically talk about, like, for our listeners, can you give kind of a quick rundown on like what inspired you to build your own advice-only financial practice?
So I'm a career changer. So I was an accounting major, undergrad, and then had a career in corporate tax that lasted the better part of 2 decades, almost 18 years. If you include law school, that was a piece of it. But I had that sort of itch around personal finance. And so I did at night a certificate program in financial planning and explored ways to open up my own practice and ultimately scratch that itch. And one thing that sort of happened to me as I was doing that journey was I found the financial independence movement, the ChooseFI podcast, early 2017. And, before that, I was very interested in personal finance, but it was all these one-off things like, passive investing or the backdoor Roth IRA or, name your favorite tactic or strategy. When financial independence came into the picture, it was like, okay, it's like the job site for a new house. Granite countertops, the sinks, the heating and cooling, all that stuff, they're different components and pieces, and they're all just laid out at the job site. What financial independence did for me was it put together the house. It took those different components and said, why are we doing this stuff from a financial perspective? And so that was very helpful for me. And so I've been running my own practice now about 6.5 years. And I'm very tax interested and tax focused. So that's sort of the reason I sort of lead with that, just because it's a big interest of mine. And yeah, so I focus a lot on tax strategies that are particularly applicable for folks in the FI community. And there's certainly going to be a lot of folks in the FI community that want to think about charitable giving and ways to tax optimize for it. And there absolutely are ways to optimize for charitable giving, which we'll talk about today.
Yeah, that's awesome. So before we kind of jump into the charitable giving piece, you do have a brand new book out that you co-authored with Cody Garrett called Tax Planning to and Through Early Retirement. Give us just like kind of a quick riff on like what this book is, like what it covers, and who's it really written for?
I like to joke, we wrote a niche book for everyone, meaning it's for anyone thinking about retirement and particularly early retirement. And there's some crazy statistic about 70% of Americans retire before enrolling in Medicare, which is the month you turn age 65. So that's how we define early retirement. So that's a pretty broad audience. And we wrote it with both the accumulator in mind, those who are going to work every day, trying to build up assets for retirement, and those in the early and even mid parts of their retirement. So we go through all the tax tactics and strategies. And one thing I'll say, in this space, there's been a lot of fear about taxes in retirement, particularly the later part of retirement. We say, why don't we just break this down? Let's, bust out some examples. and see just how bad is it, and is there planning that can be done that's relatively simple. And so that's what the book dives into: building up assets during our careers, and then draw down tactics and strategies. And we try to break through the inchoate fears that are sort of out there. Oh no, my retirement accounts are going to get taxed. Well, they're going to be taxed, but it's probably not going to be that onerous, not that bad. And so we go through all the different tactics and strategies that a lot of folks talk about, including charitable giving tactics and strategies.
Awesome. Yeah.
So yeah, the book came out in September. It seems to be doing well on Amazon, and we hope folks read it and enjoy it, and we hope it sort of furthers the conversation around drawdown tactics and strategies in particular, because we feel like those have not gotten enough attention in granular detail. Part of the reason is podcasts and Instagram reels are just, they require a little bit more nuance. And when you write over 300 pages, you have a little more room for some nuance. And so we go into a lot of those tactics and the drawdown stuff in particular.
Sure. Yeah. And I could definitely tell, like, I wish this book had been around just a few years ago. I mean, again, I was at one of my Camp FI events. I had not yet retired. I was still working, and one of the breakout session was around tax planning. And again, that's when I first discovered you. People were referencing you and your blog and a lot of things. And like you said, I was really scared because there was so many things. People were talking about all this tax planning and how to be more efficient with taxes and which bucket to draw from to minimize the taxes when you're in retirement and all this stuff. And it was so foreign to me. I was super, super nervous and scared, a few years ago when I was like, man, I don't even know where to begin.
This book will definitely give you that. But it is an overriding theme of our book is no fear. Taxes are just laws. There's too many of them, but that's a different conversation for a different day. There's really no reason to fear taxation in retirement. One of our sort of theses is, if you're going to have some tax inefficiencies, and that's what they boil down to, inefficiencies, not disasters, inefficiencies.
Right.
If you're going to have tax inefficiencies in retirement, it almost certainly coincides with wild financial success. So yes, let's do some tax planning to minimize those inefficiencies. But if the worst case outcome is wild financial success and some tax inefficiencies, it's not that bad of an outcome. Yeah, sure. Let's try to get closer to that type of an outcome, or maybe a wildly successful outcome with less or no tax inefficiencies as best we can. But I think sometimes there are segments of the industry that are not harmed, let's say, by folks fearing taxes in retirement. Let's put it that way.
Sure.
And so we try to tackle that and just say, hey, let's boil this down. Let's break this down and see what it really looks like. And then are there tactics and strategies that can make it better?
Awesome. I love it. I'm glad that this book came out. This is going to be awesome. And so let's actually now transition that to, again, charitable giving. So when you and I were talking at FinCon, something that you mentioned to me really kind of caught my attention, because you said something about like 2025 can be a really like strategic year for charitable giving. And so I want to start there. Like, what specifically is changing and why should people really pay attention to that now?
So there are going to be some big changes that come into play next year in 2026. So it makes 2025 a bit of a unicorn as we have the fourth quarter here. Right now, if you think about most Americans, they're either taking itemized deductions for their charitable giving. Most Americans don't itemize, though. So it's either itemized deductions or nothing. It just falls off the table on your federal income tax return. The Americans who are under 70 and a half, and those Americans who are 70 and a half and older, they have something called qualified charitable distributions we'll come back to. They're awesome from a tax perspective. So that's the lay of the land today. Well, what's going to happen next year? 2026, those qualified charitable distributions, those QCDs, they stay the same. Great, no change there. But what's changing is itemizing your deductions when it comes to charitable giving. Two big changes. One, there's going to be a new haircut. We'll talk about that in more detail. But basically what they're saying is if your income, you take your income and you multiply it by 0.5%, that is a disallowance number. Quick example, your income, say in 2026 is $200,000. Okay, multiply that by 0.5%. That means 1,000 of your charitable giving is just disallowed if you itemize. So that's interesting. So if you made a $20,000 charitable gift next year, make it $19,000 from a deduction perspective. This year it's $20,000. Next year it's $19,000 because of this new haircut that will be effective in 2026 and going forward. So that's one big change. The second big change is a bit of a democratization of charitable giving. Recall I said these days, for most of us who are under 70 and a half, the charitable giving just falls off the table because we don't take itemized deductions. That will not be true starting in 2026. Starting in 2026, for everyone who doesn't itemize, which is most Americans, and by the way, it's even most affluent Americans, you're going to be able to deduct on your tax return, even though you don't itemize, up to $1,000 per person in cash charitable contributions. It's a non-itemizer's charitable contribution deduction. So that's $2,000 for a married couple. And think about it too, the folks in the audience who might not be as affluent, they're sort of still growing their wealth and building towards financial independence. $1,000 might be most of their charitable giving, or certainly for a married couple, $2,000 might be most of their charitable giving. So all of a sudden they're getting a tax break for that they did not have in the last few years. These are two big changes, and they're sort of at the two poles. The pole where we're not as affluent, okay, we can deduct up to $1,000 in these cash gifts. And then the pole where we might want to be giving more, we now have this haircut up to 0.5% of our income starting next year, where we're not going to be able to deduct 100 cents on the dollar. For those people, it's going to make more sense to accelerate into the fourth quarter in many cases their charitable giving this year. We could talk about one great way to do that is the donor advised fund. We'll talk about that a little bit more later.
Got it. Well, let's actually talk a little bit about that. So, you mentioned QCDs, you mentioned donor advised funds. There seems to be, and there's a lot of ways that people can donate to the causes that they're are important to them. And a lot of times just use, like you said, cash after the fact, right? Can you kind of break down like some of the differences on ways that people can donate, and then kind of like in order, which is best, and as we go down the path?
All right. So let's think about a donor to something like the Lugar Foundation, which hopefully the listeners are aware that Chris started his own foundation, the Lugar Foundation, that helps families with children in the NICU unit, and it helps with ancillary expenses, parking, I believe hotels and other expenses that relate to that experience of having a child in the neonatal intensive care unit. So let's say you had a donor who has two objectives. One is to support the Lugar Foundation. Great. The other one is this donor might be saying, hey, I want a big upfront tax deduction in 2025. And then, in 2026, I'll just go back to the standard deduction. It's relatively high, 2027, 2028. So most donors do not like to give a one-time big gift to a charity like the Lugar Foundation and then walk away and say, hey, please don't bother me for the next 4 years. Maybe in 4 years, I'll give to you again. What most donors like to do is they like to have a normalized relationship with the charity. So let me put some numbers to this, right? So few donors are going to want to give $20,000 to the Lugar Foundation this year and then say, hey, I don't want to hear from you guys for 3 or 4 years. A lot of donors might want to say, I want a $20,000 deduction this year, but what I'd rather do is give maybe $5,000 this year and $5,000 next year and $5,000 in 2027 and maybe $5,500 in 2028, sort of normal payments for the most part. So how does that donor do that? Well, the donor advised fund is the retail level solution to that quandary. So what a donor could do is he or she could move $20,000 of cash, or another great asset for this is appreciated stock, the old tech stock that went to the moon. You could just move.
I was going to touch on that later on, but now that you brought it up, absolutely, yeah.
Yeah, so move the tech stock that went to the moon. You move the $20,000 into the donor advised fund. The donor advised fund itself is going to sell that almost certainly, and then you can invest it in sort of like bond type stuff, cash type stuff, and sort of conservative investments, generally speaking. But, I'm not giving investment advice for you or any donor advised fund or any person there. But generally speaking, many times in donor advised fund, we tend to be a little more conservative with our investments. Okay, so you move that tech stock into the donor advised fund, that capital gain is washed away. So that's why we like donating appreciated stock. What you could then do, and you get the upfront deduction. So you take that deduction in 2025, no haircut, no worrying about, oh no, my income's too high. That's not a problem. And then you give 3,000, 4,000, 5,000, 6,000, whatever you want to the Lugar Foundation or other charities in 2020. You could do it in the remainder of the year if you were so inclined, or in 2026, 2027, 2028. There's no deadline for, it's got to be out of that by a certain time. They're very flexible. And I will say, I'm just going to make a brief comment here. I'm not here to endorse any provider. My understanding, and you need to go on the internet and verify this, is that Fidelity and Schwab's donor advised fund equivalents today have no minimums in terms of initial contribution to the donor advised fund and in terms of donations to the charities. My understanding is Vanguard targets a different type of investor for their donor advised fund. So there's rather substantial minimums in terms of both the contribution into the donor advised fund and the actual gifts to the charities. Right. So in theory, with a Schwab or Fidelity donor advised fund, you could, make $100 gift here, a $50 gift here, a $5,000 gift there, so you could be a little more flexible. That's my understanding. You got to do you on your research. The donor advised fund essentially increases and accelerates the charitable deduction, which we like, and it normalizes the relationship between donor and charity. So it's a great mechanism. And so, like, for those who are a little more affluent, who have especially appreciated stock, the donor advised fund might be the way to go. Now, you can give. Now, you'd have to look at each charity. If can they even accept appreciated stock? You'd be surprised, but not all charities can accept appreciated stock. Charities will accept cash. That's not going to be an issue. So in theory, you could just give the appreciated stock directly to the charity. But now it's this one-time hit. And look, that might be the right answer in your particular situation. But a lot of donors like this idea of, I'm going to have a bit of a more normal relationship with the charity while still getting my upfront tax deduction. So that's a thought.
Awesome. Yeah, I love that. And so let me ask you a question. Again, forgive my ignorance, but let's say I slipped this donor advised fund and I was able to have this, let's say $20,000 deduction this year, right? Next year, could I add another $20,000 to that same fund, right? Can I keep that ball rolling?
100%, Chris. So yes, you can do it. Now, the only drawback for next year will be, you're going to have to pull out your income. And if it's high, so let's just say your income was $500,000 next year. All right. So your income is $500,000. I'm going to do some math on a podcast, always dangerous. But my quick and dirty on that is you would lose, if you put another 20,000 in, your deduction would only be $17,500 because you have the 0.5% floor next year, not this year. So your deduction would be the 20,000 would be the starting point, and then we would subtract out 0.5% of your income. I've got you at 500,000 of income just for the example. That's 2,500 of a subtraction. So your deduction would only be the 17,500. So in a case like yours, that we're talking about now, I'm not saying it's your advice, but it'd be a real shame for that same person to put 20,000 of appreciated tech stock in the donor advised fund in December, and then another 20,000 in January of 2026. Why not just put the 40 in 2025 and get the full deduction? But anyway, so that is out there as, these donor advised funds are very flexible in terms of, what you do, so you can donate to them at any time and potentially get a tax deduction, assuming you're itemizing, but I'm talking about a more affluent person. And then you can give out of them relatively flexibly, including recurring gifts. So folks do this for their church donation every month, or I'm not sure if you can do every week. You got to look at the different parameters, but maybe every month you could just set up a recurring gift for the church. So you could sort of put that on autopilot out of the donor advised fund. Yeah, they're very, very flexible.
Dude, that is awesome. I'm learning so much. I mean, that's one thing where I know I've talked to a few people that are in like the monthly in-person Stacking Benjamins group. We're going to actually talk about later in November. Again, in person, we're going to talk about ways that we can give back, ways that we can help those organizations that are important to us. And I mean, I'm relatively new to donor advised funds. I don't have one. I feel as though I should, in all seriousness, a lot of my personal income does go to not only my foundation, but so many other causes that I care about. So this is something that I definitely got to take advantage of. And I'm going to call my money guy right after this.
Well, so Chris, let me just sort of make 2 points on that, right? Maybe 3 points. The donor advised fund is just a tactic, right? There are going to be people who are successful financially without them and who give and support charities without them. It's definitely a nice to have, but it's not required for financial success. So I'll give you one profile who might want to think very heavily about the donor advised fund, and then one profile that would probably not want to think about the donor advised fund much. So the profile that would want to think more heavily about it is the appreciated stock owner. So, maybe you worked for a tech company, you got all this employer stock that went to the moon, it's in a taxable brokerage account. Donor advised funds are a great way of using that stock to make your charitable contributions and avoiding the capital gains tax. Because what you don't want to do is, I'm going to sell this stock first and then put the cash in the donor advised fund. No. And also the other thing, if you have built-in loss stock, you don't want to put that in the donor advised fund. You want to do the exact opposite. You want to sell it, pop the loss, and then put the cash in the donor advised fund. All right. So appreciated stock owner, you gambled on name your retail big tech company and it worked. And okay, that's the very ideal candidate for the donor advised fund. Where the donor advised fund loses its luster is going to be a lot of Americans who are 70 and a half and older, because a lot of those folks are going to have larger traditional retirement accounts, aren't going to have as much appreciated stock, if any, and they have access to the qualified charitable distribution, which is a great tactic. So I think this is going to be the emerging wave in terms of charitable donations as boomers get older, Xers like myself get older, is you get to 70 and a half, you go into your traditional IRA, you go to the custodian, there's going to be some functionality to do this. You say, hey, my church donation, the 500, the 1,000 a month, send that directly from my IRA to the church. What this does is it takes what would have been a taxable pot of money, your traditional IRA, and it's a tax-free way of getting that money out. Now, it goes to charity, so you got to be charitably inclined. But that person who's 70 and a half or older is going to take the standard deduction, which is very high now, and they get to exclude from their income that otherwise taxable distribution. It's you're combining now the charitable deduction with the standard deduction. In effect, very, very good planning. It's whittling down those traditional IRAs. And oh, by the way, once you're subject to these RMDs, the required minimum distributions, the QCD can count against the RMD amount. So say you have an RMD from the account, your RMD age. You have a
Explain really quick what a
so
required minimum
in our
distribution.
70s, the Internal Revenue Code, the tax law of the land, requires you to start taking a minimum distribution from your traditional retirement accounts. It's essentially, hey, you've had the tax deferred on those for a long time. So now what we're doing is we're saying, over the rest of your life expectancy, you have to take out a minimum percentage. They actually tend to be very small. For a 75-year-old, it's 4.07%. And I know this isn't the safe withdrawal rate episode, and there's plenty of podcasts on that. But I think you and I could probably agree that 4.0% for a 75-year-old is probably a safe withdrawal rate. In fact, for, I believe, an 85-year-old, it goes up to something like 6.25%. So that's probably a safe withdrawal rate for an 85-year-old, right?
Sure.
So anyway, so they're pretty small. But yeah, you got to take them, and they're generally taxable. But let's just say it was $50,000 in 1 year. Okay, but you tell the custodian, the Vanguard, the Fidelity, the Schwab, the E-Trade, name your custodian. You tell them, well, every 15th of the month, send $1,000 to my church, and it's a 501c3 charity and all that good stuff. Okay. So now that's 12,000, 1,000 times 12 months. That's 12,000 that counts against the RMD and is not taxed. So to meet your RMD requirement, you only have to take 38,000 out. That would be taxed in that example, and that's fine. But it's a great way of lowering our taxes when we're otherwise charitably inclined, and we're in our 70s and 80s, and hopefully we've been financially successful. Why not be a little charitably inclined, right? Why not share the wealth with some good causes? So anyway, so that's part of the, I mean, yeah, these QCDs, once we get into our 70s and 80s, are just fantastic tax planning. It's part of the reason I like charitable or giving to like a 401k at work when we're building up our assets to the traditional 401k, because some of that's going to come out as a tax-free QCD anyway. That's fantastic. So yeah, QCDs are the cat's meow as far as I'm concerned when it comes to tax planning and these charitable contributions.
Yeah, that's awesome. Yeah, I was talking to one of my uncles. I had a family gathering over. We had a big fish fry over at my house. I typically host all those, and one of my uncles is now over that 70 and a half age, and we are talking about QCDs, and yeah, he was saying that, basically to not be taxed on it, he was basically donating all that to like St. Jude's, right? Which was super awesome. I'm like, yeah, I mean, if you don't need it, right? If you don't need that RMD, then go ahead and maybe donate that to somebody that could use it. I don't know. That's the way I think about it.
Yeah, it's, I believe the annual limit on them is something like 108,000. It's adjusted for inflation now. And, most Americans, even if they've done very well, $100,000 is going to be, few of us are going to be donating 100,000 a year to charity during the rest of our lives. So it's very, very powerful, and it's a great use of an unneeded or unwanted RMD. And it manages for taxes so well. And, these days, a lot of Americans combine a high standard deduction. There's an additional deduction if you're 65, and now there's a second additional deduction if you're 65. So you could have this very high deduction and these, exclude from your income these QCDs, which is effectively deducting them. It's the same effect. So it's very powerful planning for our 70s and 80s. I mean, we've got to be otherwise charitably inclined, to be fair. But as long as we're charitably inclined, boy, that could be very powerful.
That's awesome. And like, if you have, let's say people are feeling charitable, and they want to give those, smaller donors, right? Just the average American, and maybe they don't have, they don't have a donor advised fund set up, and they may be giving cash. What are some just high level basic things to consider when you're saving those receipts? You're going to itemize, you're going to try to deduct that. Because I mean, for years I've heard that, well, it really doesn't matter because you're not giving enough to make a difference on your taxes. Is that true? Like, kind of explain some of that.
Well, so in a sense, it was largely true for, 90% of Americans, something like that. It might be a little less than that, but 80 to 90% of Americans over the last few years have just taken the standard deduction, which means on your federal tax return, you're not claiming any benefit for your charitable contributions. Let's put QCDs to the side for this purpose. So it didn't really matter. I mean, maybe you were taking a state tax deduction. That can vary state to state, but okay, it didn't matter all that much. But now, in 2026, save some receipts. Usually you get that letter from the charity. Save that. And, today it's almost certainly going to be emailed to you. So set up an email file. You just got to save it. And now, as long as they have to be cash to get this $1,000 deduction. But this is going to be a big thing. I mean, look, is anybody going to have financial success because they took $1,000 tax deduction? No, but why not, right? Why not? If the government is going to make your charitable giving cost be a little, you're essentially getting 22 cents on the dollar, 24 cents, whatever your marginal rate is for federal purposes, which, if you're single and you're making over 200,000, that could easily be 32 cents on the dollar. So if you gave $1,000 in cash gifts, you save those receipts. Now you got $320 back. Now, look, I get $320. Even now, that's a couple of trips to the grocery store at least. That's real money. So just say, do your best to save those receipts. You could always go back to the charity and email for an additional, if you somehow lost it. These days with email receipts, it tends to be good. Or scan, if you get the thing in the mail, scan them. So anyway, so I think it's a nice little opportunity, and it sort of has this interesting effect of sort of democratizing charitable giving tax benefits, right? Typically those benefits have resided sort of in the higher levels of the income scale of the world, and that is what it is. But now going forward, even those of us who maybe aren't taking itemized deductions, aren't 70 and a half, so we can't get the QCD thing yet, can get at least some benefit, especially, you're a married couple, that could be $2,000. So that can be helpful.
I love that. I love that. And I'm going to ask you a question too that's always just confused me, and maybe you'll have some advice here. But I remember always kind of like figuring out the non-cash donations. Let's say I
Yes.
bring boxes of stuff to the Goodwill, you know, several times throughout the year, whatever. Like, every couple months, I bring boxes of stuff to Goodwill. I never know what to do or how to. I mean, I know I can go on their website and they literally have a list of like 50 cents per pair of pants and $1 per suit or whatever. Explain a little bit on how people can leverage that if you are doing stuff like donating it to a thrift store or something like that.
Yeah, and this gets very subjective. You certainly want to get a receipt from the intake, from the Goodwill or whoever it is that you'd made donations of household items. And, to my mind, it's sort of keep as good a records as you can and make the best approximation. There's generally a form on a tax return. It's called an 8283. It's a little complicated, unfortunately. Non-cash charitable gifts. So there's the non-cash charitable gifts that it's like the thrift store stuff, right? So that has to go on this form 8283. And if you're not itemizing, it doesn't really matter. But if you are, then it absolutely can matter. The other one would be for appreciated stock. So that requires that form. That's a little easier because I believe, and you'd have to look this back up on the internet. I've done this, I always sort of have to go back and look this back up in my notes. But essentially, if you give a publicly traded security, so like, a mutual fund, an ETF, an individual stock, so it has a ticker, you go on the date that the charity got it, I believe, and I think it's the average of the high and the low. Don't quote me on that. I always have to go back and look that up. I don't believe it's open and close. I think it's high and low, but just you look up the right rule and you say, oh, there's 100 shares and I average these two things and that's my deduction. And I put that on my tax return. I put that on my A283. So for some of that stuff, it's a little subjective. The publicly traded stock and securities tends to be a little easier just because the rules are out there. Dr. Google can help you figure out those rules. But anyway, yeah, like for that, and then like you can have some bigger ones where it's like a car or something like that. You might need some appraisal, so that can be a little more funky. For the really bigger ones, that you'd have to look into more. I will say this though, you go through, you clean out your closets, you make some contributions to Goodwill. Is the value of that really going to make that big a difference as a one-time tax benefit? Probably not. But, do the best you can and certainly don't be over aggressive on claiming a deduction.
Sure. I mean, the value for me would be more just of not having the clutter.
Yes, that's right. That's exactly right. Yeah, it's like, do we, okay, like we got to clean out this clutter. All right, get the tax deduction, but do we have to really obsess or take every last nickel?
Right. Yeah. I was like, early on, I would always like take pictures of the boxes and I would get the receipt and I would write down and I'm like, it doesn't really matter. Yeah. So as we kind of like wrap up here, like for those people that are working towards financial independence, right? They're in their 50s, maybe 60s. I guess what kind of key takeaway do you want to leave them with as far as like setting up their finances to take advantage of charitable giving strategies, either, now or in the future?
So I think the big one for the future is the traditional retirement accounts because the QCD opportunity is just so good. I would say, look, contribute to 401ks at work. I'm not giving advice to anyone, but educationally and directionally, boy, having some money for our 70s when we've sort of cleared some of our financial hurdles in our life, boy, that makes a lot of sense. So to my mind, that makes a whole lot of sense. And then, if you've got, I tend to favor simplicity in a portfolio. So I don't like, hey, I'm going to go invest in this individual company and I'm hoping it's going to be the next, great thing, and so, it'll go to the moon and then I can give some of it to charity. I don't like to structure my affairs that way, but there are people out there with individual equities. And if you do have an individual equity that has really appreciated, That's the thing to be thinking about. One, it's a great live off asset first in early retirement, but two, in terms of charitable giving, it's a fantastic asset. Even during your working career, because you get that deduction at ordinary rates against your W-2 income. So those would be like the two things. One, I think just traditional retirement accounts at work because the future QCD benefit is so high. And then two, if you already have these individual equities, that have really gone up, you want to be eyeing those and thinking about charitable giving with those.
I love it. And I'm not really into like individual stock investing either. But one thing, if you work at an employer, like for instance, for me, not only did I get restricted stock units, so I'd get those RSUs granted to me. So I'd have those shares of stock. Plus I was purchasing stock at a discount with an employee purchase program. So I had large large quantities of shares that had gone up. And so I could leverage those. So cool. That's awesome. Sean, I want to thank you so much for hanging out today. I learned so much, and I want to let you share people where's the best place to get in touch with you, follow you, and then also make people know again where they can find your book.
Okay, so Chris, thanks so much for having me today. Really enjoyed our conversation. My internet home is FITaxGuy.com. It's my blog. I've got links to other things about me that you can look up from FITaxGuy.com. And then the book. So the book is on Amazon, Barnes & Noble, I believe Walmart.com, other online resellers. My understanding is you can call your bookstore and they'll order it for you and you go pick it up at your bookstore. And the book is called Tax Planning to and Through Early Retirement. I co-authored it with Cody Garrett.
Awesome. I love it. Cool. Well, thank you so much, Sean. I really appreciate it. And thanks everyone for listening, for following along. And please like, subscribe, and share wherever you get your podcasts or on YouTube. And we'll see you next time on the Extreme Personal Finance Show.